I made my first $1 million when I was 40 years old, and my first billion when I was 75. Do you want to know the difference? The secret that separates those two numbers? I stopped doing what fools do. It's that simple. Everyone, everyone is searching for the magic formula, the secret stock tip, the perfect time to get in the market. It's a collective delusion, a fool's errand. Let me tell you something. There is no secret. There is only a short, permanent list of boneheaded stupidities. And if you can just sidestep those, you don't have to be a genius. You just have to not be an idiot. That's the whole game. I have watched brilliant minds. I'm talking about physicists with IQs you couldn't measure, financially incinerate themselves. I've seen them lose their homes, their families, their dignity. Why? Because they violated one of these obscure rules that secretly govern the world of money. These aren't suggestions. They are the laws of financial gravity. And gravity, well, gravity always wins. Today, I'm giving you that list, the real list. 8 rules. If you're violating just 3 of these, you're not just losing money, you're losing decades. You're already 10 years behind and you don't even know it. So listen up. Rule number 1. You're trying to be brilliant instead of just avoiding stupidity. Wrong approach. Utterly, fundamentally wrong. This is the sin of the intellectual, the person who thinks their big brain gives them an edge. It's an anchor, not a propeller. I don't try to jump over 7-foot bars. I look around for 1-foot bars that I can step over. The game of investing is not about making brilliant, difficult decisions. It's about consistently not making stupid ones. It's a game of avoidance. Look at long-term capital management, LTCM. In 1998, they had 2 Nobel Prize winners in economics on their board, the smartest guys in the room. They built complex models that said they couldn't lose. They leveraged themselves to the moon. And then a little thing called Russian bond defaults happened. Something their models said was impossible. They were so brilliant, they couldn't conceive of being wrong. They blew up so spectacularly, they almost took the entire global financial system with them. Brilliance is fragile. Avoiding stupidity is robust. You spend hours trying to predict the next big tech revolution. You read dense analyst reports you don't understand, but you don't even know if the company you just bought actually makes a profit. You're trying to play chess in the 4th dimension when you haven't even mastered checkers. It's pathetic. Here's the rule, the inversion test. Before you make any financial decision, stop asking, how can this succeed? Instead, ask, what are all the ways this can go terribly, horribly wrong? Think about failure first. What could kill this investment? Competition, bad management, a change in technology, a change in regulation. If you can't list at least 5 plausible ways it could fail, you have no business owning it. Your homework. Before your next investment, you will write down on paper 5 reasons it could go to zero. If you can't do it easily, you pass. You don't buy it. Rule number 2. You are chronically underestimating the power of incentives. This drives me crazy. You think people make decisions based on logic, or morality, or what's best for the company. That's naive. It's childish. People do what they are incentivized to do. Period. End of story. If you don't understand the incentive structure, you understand nothing. My approach is simple. I never ever underestimate the power of incentives. Show me the incentive, and I will show you the outcome. This is as close to a superpower as you can get in business and in life. Remember Wells Fargo? A few years back, they paid billions in fines because their employees were creating millions of fake bank accounts. Millions. Were these thousands of employees all just born evil? Of course not. The incentive structure was poison. The bank had an insane cross-selling quota. Employees were told, open 8 new accounts for every customer, or you're fired. So what did they do? They opened fake accounts. They responded to the incentive. The management got their bonuses, and the bank's reputation was torched. You do the same thing. You buy a financial product from a friendly advisor. You think he has your best interest at heart. You don't ask him, how are you paid? You don't realize he gets a massive commission for selling you this particular high-fee, garbage mutual fund. His incentive is not to make you rich. It's to make himself rich. You're a sheep walking into a wolf's den, and you're wondering why you keep getting eaten. Here's the test, the compensation test. For any person or company you deal with, you must be able to answer this question in one sentence. How do they get paid? If you don't know the answer, run. If the answer is complicated, run. If their incentive is not perfectly aligned with your own, run. Your homework, go look at your investment portfolio. For every single fund you own, find out the expense ratio. That is the incentive the fund manager has to take money out of your pocket every single year. You will be horrified. Rule number 3. You think the world is driven by greed, but you ignore its more powerful cousin, envy. Greed is simple. Greed just wants more. Envy is a cancer. Envy doesn't just want more, it wants you to have less. It is the most irrational and self-destructive of all the human emotions, and it powers more bubbles and crashes than anything else. I have spent a lifetime trying to avoid envy. It's the one sin you can't have any fun at. It only makes you miserable. I don't care if my neighbor gets rich off some stupid new technology. Good for him. It doesn't affect me, but you. You see your idiot neighbor, the one who can't even mow his own lawn, get rich on some cryptocurrency with a dog on it, and you can't stand it. The envy eats you alive. So you take your life savings, money you can't afford to lose, and you pile into it at the absolute top. You're not investing. You're just trying to quiet the gnawing feeling that someone else is getting rich and you're not. This is not a financial strategy. It's a psychological disease. The entire dot-com bubble of the late 90 seconds wasn't about greed for a better future. It was about envy. It was secretaries and janitors watching their bosses become paper millionaires overnight and thinking, why not me? That feeling, that why not me, has caused more financial ruin than all the bad business models in history combined. The rule, the neighbor test. When you feel the urge to make a quick investment, ask yourself, am I doing this because I've done the research and it's a sound business? Or am I doing this because I can't stand the thought of my neighbor getting rich without me? If it's the latter, go for a walk. Turn off the computer. Do anything but buy. Your homework. Unfollow every single financial influencer on social media who posts pictures of their Lamborghinis or watches. You are not consuming information. You are mainlining pure, uncut envy. It's poison. Get rid of it. Rule number 4. You are operating outside your circle of competence. This is a big one. You think that because you're a successful dentist or a great lawyer, you're qualified to pick biotech stocks. You are not. You are a patsy at a poker table full of sharks. My partner Warren and I, we have a very simple rule. We have 3 boxes, in, out, and too hard. We spend all of our time on the in box. We don't even look at the too hard box. We are not smart enough to figure everything out, and we know it. The key is not the size of your circle of competence. The key is knowing where the perimeter is and staying the hell inside of it. Look at the history of corporate acquisitions. The vast majority of them fail. Why? A company that makes fantastic soft drinks decides it should own a movie studio, A successful software company decides it needs to get into the hardware business. They step outside their circle of competence, pay a fortune, and proceed to destroy shareholder value. It's hubris, plain and simple. You do it on a smaller scale. You read one article about artificial intelligence, and suddenly you're an expert, throwing thousands of dollars at some AI company whose business model you couldn't explain to a 10-year-old. You're not investing, you're gambling, but you call it investing to feel smart. The test, the explanation test. You must be able to explain in simple terms that a child can understand exactly how the business you are investing in makes money. What does it sell? To whom? Why is it better than its competitors? If you start using buzzwords like synergy or paradigm shift or disruption, you don't know what you're talking about. You failed the test. Your homework. Sell it. Today. If you own any stock that you cannot explain simply and clearly, sell it. I don't care if you take a small loss. It's a tuition payment for a valuable lesson. The money you lose from ignorance will always be greater than the money you lose from selling something you don't understand. Rule number 5. You are attracted to complexity, and you are repulsed by simplicity. The human brain loves the puzzle. It loves complexity. It assumes that a complex problem requires a complex solution. In finance, the opposite is almost always true. Complexity is used to hide fees, to hide risk, and to hide fraud. Simplicity is a sign of honesty. My entire philosophy can be boiled down to a few simple ideas. Buy wonderful businesses at fair prices. Hold them for a very long time. Let compounding do the work. It's simple. It's not easy, but it's simple. Remember Enron? Before it collapsed into one of the biggest frauds in history, it was the darling of Wall Street. Why? Because it was complicated. They had special purpose entities and Byzantine accounting tricks. No one understood their financial statements, but because it was complex, analysts assumed it must be brilliant. They were embarrassed to admit they didn't get it. That complexity was a smokescreen. It was a place to hide the lies. You do this every day. You're drawn to the investment strategy with the fancy name, the quantum macro hedging arbitrage strategy. It sounds smart. It sounds sophisticated. The guy selling it to you uses a lot of charts you don't understand. What you don't realize is that it's just a way to charge you 3% in fees to do something you could do yourself with a simple index fund for almost nothing. The rule. The Occam's razor test. When presented with 2 explanations or 2 investment strategies, the simpler one is almost always the better one. If someone cannot explain their strategy to you on the back of a napkin, it's because they are either trying to confuse you or they are confused themselves. In either case, you should have nothing to do with it. Your homework. Read the annual letter from a company known for its simplicity, like Berkshire Hathaway. Then try to read the annual report from a complex financial institution. One is written in plain English. The other is written in gibberish. Invest in the one you can understand. Rule number 6. You are a man with a hammer, and to you, everything looks like a nail. You learn one way of thinking, and you apply it to every problem. If you're an economist, you think everything is a supply and demand problem. If you're a psychologist, you think everything is a cognitive bias problem. You're a one-trick pony in a world that requires a whole stable. I believe in building a latticework of mental models in my head. I've taken the big ideas from physics, biology, psychology, economics, history, and I use them as a toolkit to understand reality. You can't understand a complex system like the market through a single lens. It's like trying to describe an elephant when you're only allowed to touch its tail. The 2008 financial crisis was a perfect example of this failure. The economists had their models that said a nationwide housing collapse was impossible. They were the men with the hammer of efficient market theory. They completely ignored the psychology of the situation, the mania, the fraud, the breakdown of lending standards. The bankers were men with the hammer of short-term profits. They ignored the historical lessons of past bubbles. Everyone was stuck in their own silo, and they flew the entire plane straight into the side of a mountain. You do this when you rely on a single source for your news, or a single metric to evaluate a stock. You might look only at the price-to-earnings ratio. You're ignoring debt, management quality, competitive advantages. You're looking at one nail and ignoring the fact that the rest of the house is on fire. The rule, the multidisciplinary test. Can you describe the problem or the investment using ideas from at least 3 different disciplines? Can you look at it from an economic perspective, a psychological perspective, and a historical perspective? If you can only use the jargon of one field, your view is dangerously narrow. Your homework: read a book on a topic completely outside your field of expertise. If you're in finance, read a book on evolutionary biology. If you're a doctor, read a book on military history. Start building your lattice work. It's the only tool that works. Rule number 7. You are addicted to action. You confuse activity with achievement. The stock market is the one place where you can get paid for doing nothing, but people can't stand it. They have to be fiddling, trading, buying, selling. They think if they're not doing something, they're falling behind. It's a casino mentality, and the house always wins. The big money is not in the buying or the selling, but in the waiting, in the sitting. It's what I call assiduity, the ability to sit on your ass and do nothing. It's the most underrated skill in investing. Look at the average day trader. They make dozens, even hundreds of trades a day. They're constantly active, and study after study shows that the vast majority of them lose money. They get eaten alive by commissions and bad decisions driven by emotion. They mistake the frenzy of activity for progress. You feel this itch too. Your portfolio is down 2% for the day. You feel you have to do something. So you sell a good company at a loss and buy something else you know nothing about, just to feel like you're in control. You are not in control. You are a leaf in the wind, and your emotions are the storm. The rule, the 5-year test. Before you buy any stock, ask yourself, would I be happy to own this business if the stock market shut down for the next 5 years? If the answer is no, you are not an investor. You are a speculator. And speculators always eventually go broke. Your homework: check your portfolio once a month. Not once a day. Not once a week. Once a month. If that sounds impossible, you have a problem. Your addiction to the screen is costing you a fortune. And finally, rule number 8. You are trying to learn from success. This is the most subtle and dangerous mistake of all. You read books about how great entrepreneurs succeeded. You study the habits of billionaires. You're studying the wrong thing. Success is a terrible teacher. It's full of luck, randomness, and survivor bias. For every founder who succeeded by dropping out of college and breaking all the rules, there are 10,000 who did the same thing and ended up bankrupt. You don't hear their stories. You only see the winner. It gives you a dangerously distorted view of reality. I have learned more from studying failure than I ever have from studying success. I study disasters. I study bankruptcies. I study frauds. I want to know what kills a business. I want to know what patterns of behavior lead to ruin. Success is a mystery. Failure has a blueprint. Look at Kodak. They invented the digital camera and then buried it because they were afraid it would hurt their film business. They failed to adapt. Look at Sears. They were the Amazon of their day, a titan of retail. They got arrogant and complacent and missed the shift to online shopping. These are not stories of bad luck. These are stories of specific, identifiable mistakes. Those are the lessons that stick. You're chasing the top 5 stocks that will 10x. You're reading articles about the secrets of the millionaire mind. You're learning nothing. You're just consuming financial entertainment. The rule, the autopsy test. Spend more time reading business obituaries than business biographies. For every success story you study, you must study 2 failures. Ask not, what did they do right? But what was the fatal mistake they made? Your homework. Pick one massive business failure from history, Enron, Lehman Brothers, Blockbuster, and spend one weekend reading everything you can about it. Understand the sequence of bad decisions that led to the collapse. That one weekend will teach you more than a year of reading success stories. So there you have it. 8 rules. Avoid brilliance. Understand incentives. Kill envy. Stay in your circle. Embrace simplicity. Think broadly. Do nothing. And study failure. This path, it won't make you a star on financial television in 6 months. It's not sexy. It's not exciting. But in 20 or 30 years, while the geniuses are on their 3rd bankruptcy and the gamblers have all gone home broke, you'll be the one there quietly asking for a loan. Most people have already clicked away from this. They're gone. They're searching for that one weird trick or the next Bitcoin. If you're still here, it means you're serious. It means you're part of the small minority that actually gets it. This channel isn't about stock tips. It's not about hype. It's about permanent principles, timeless wisdom that works because it's based on the unchanging, flawed nature of human beings. If that's what you want, subscribe. If not, please, go somewhere else. Now, if you'll excuse me, I have some annual reports to read. Go do the boring work that makes you rich.